Every day, millions of traders wake up with hope. They sit in front of their screens, believing this will be the day they finally master the markets. But within an hour of the market opening, that confidence turns into confusion. Charts move violently, emotions rise, and before they even realize it, they've taken 5 trades, broken every rule they swore they'd follow, and watched their account shrink again. It's not that these traders don't know how to trade. Many of them have studied for months, even years. They understand candlesticks, indicators, and market structure. But what they don't understand is timing and restraint, two of the most underrated weapons in a trader's success. The truth is, you can have the best strategy in the world, but if you trade at the wrong time, overtrade out of impulse, or spend too long glued to the screen, you will still lose. That's why this rule, the 912 rule, exists. This is something I personally developed, a day trading rule that completely changed the way I trade, how I think about the market, and most importantly, how I protect both my money and my mind. This is my rule, my structure, and the framework that has saved me from the chaos that destroys most traders. It's the product of trial, loss, observation, and eventually, clarity. This is about finding the right trade at the right time and protecting your mental and emotional capital every single day. So, if you've ever felt like trading is draining you, like you're trapped in an endless cycle of chasing moves and giving profits back, then this is the rule that will give you your power back. It's how you slow down, regain control, and finally start trading with precision instead of panic. Every morning, right at the New York Open, the market becomes a battlefield. Institutional traders, hedge funds, and algorithms flood the market with liquidity, and retail traders get caught in the crossfire. Price whipsaws up and down, creating what looks like opportunity, but it's just volatility designed to trigger emotional reactions. The beginner trader sees that first spike of movement and thinks, "This is my chance." They jump in. A few minutes later, the market reverses and they're stopped out. Frustrated, they re-enter, hoping to make it back, and lose again. By the end of the first hour, they're not trading anymore. They're gambling, chasing emotions, trying to fix mistakes that discipline could have prevented. That's where most people fail, not in their analysis, but in their patience. They think trading success comes from doing more, when in reality, it comes from doing less, but doing it with focus. When I first started, I made that same mistake. I thought sitting in front of the charts all day meant I was being productive. But after years of losing hundreds of dollars in my personal account and prop firms, I realized something painful. The more I traded, the worse my results became. I was tired, impulsive, and mentally drained. I wasn't following a plan. I was reacting to fear and greed. That's when I created a structure for myself, a rule that forced me to trade with precision instead of emotion, a rule that cut out noise, controlled my exposure, and gave me back my peace of mind. That rule became the 9 to 12 rule, and it's the single most effective framework I've ever used for consistent results. It forced me to trade less, think clearly, and execute smarter. Because in trading, survival comes before success. You can't grow an account you've already blown up, and this rule is designed to make sure you never reach that point again. The first part of the rule, the 9, might seem simple. Don't trade right at market open, wait until after 9 a.m. But the reason behind it is critical to understand, because this single adjustment in timing can save you from 70% of unnecessary losses. The first hour of any major session, whether it's New York, London, or Tokyo, is the war zone. It's when institutions are filling large orders, banks are adjusting positions, and algorithms are gathering liquidity. Prices spike in both directions, stop losses get swept, and emotions run high. This is when retail traders get slaughtered. They see a breakout, they buy, only for price to snap back and stop them out. Then it reverses again, and they chase the new move, only to lose twice in 10 minutes. When you wait until after 9 a.m., you give the market time to settle down. You let the fake moves play out. You watch where liquidity has been collected, and you allow structure to form. By the time you enter, you're trading confirmation. This is where professional traders operate. They don't care about the first move. They care about the real move, the smart money move, because they know that every spike before 9 a.m. is usually just a liquidity grab. Waiting an hour also gives you the psychological advantage of preparation. Instead of waking up and instantly reacting, you observe, plan, map out your levels, watch the behavior of price as liquidity shifts, and start to understand the day's rhythm instead of gambling on its first heartbeat. This concept applies across all sessions. If you trade London, wait an hour after open to let the volatility calm down and real structure appear. If you trade Asian markets, wait for Tokyo volume to solidify before jumping in. The 9 doesn't literally mean 9 a.m., it represents delayed engagement. And this single act of waiting does something powerful. It eliminates FOMO. When you know you're not supposed to trade early, you stop chasing every candle. You give yourself permission to slow down. The traders who succeed long-term are the ones who wait for confirmation. The 9 teaches you that timing isn't just about entry, it's about control. You're not late to the market, you're letting the market show you its truth before you risk a cent. And once you adopt that discipline, you'll notice something incredible. Fewer losses, cleaner entries, calmer emotions, and a deeper sense of confidence in every trade you take. The second part of the rule, the 1, is where most traders lose the battle because they lack restraint. The idea of taking only one trade a day sounds almost impossible to the average trader. Their logic says, the more trades I take, the more chances I have to win. But in reality, that's the exact mindset that drains accounts and destroys consistency. The market doesn't reward activity. The professional trader isn't looking for constant action. They're looking for precision. Every trade is a risk. Every click of that buy or sell button costs emotional and financial capital, and every unnecessary trade you take reduces your ability to think clearly on the next one. When you commit to taking only one trade per day, you immediately force yourself to raise your standards. You can no longer afford to take random setups or maybe trades. You start asking the hard questions. Is this really my setup? Does this align with my plan? Is the risk to reward ratio worth it? Suddenly, you begin to trade less, but with more purpose. That one trade a day becomes sacred, as it's a decision backed by preparation, structure, and intent. You spend the early part of your session observing the market, waiting for it to align with your criteria, and when it finally does, you act calm, confident, and decisive. This approach not only filters your trades, but also strengthens your mindset. It trains you to think in terms of probabilities, not possibilities. You stop chasing every flicker of movement and start waiting for the high probability moments that truly matter. Another powerful part of taking one trade per day is how it protects your emotions. The biggest losses traders experience don't come from one bad trade. They come from the chain reaction that follows it. You lose one trade, you get emotional, you take another out of frustration, then another out of desperation. Before you know it, you've turned a small loss into a disaster. By limiting yourself to one trade, you eliminate that downward spiral. Even if you lose once. You protect yourself from revenge trading. You maintain composure. You give your brain time to analyze what went wrong instead of doubling down on mistakes. It also creates consistency in your performance data. When you only take one trade a day, it becomes easy to track your results, recognize patterns, and understand your edge. You're able to measure progress with clarity, not confusion. In trading, less truly is more. One good trade executed with focus and discipline will always outperform 10 mediocre trades executed with emotion. The one is about mastering your system, your psychology, and your patience. Because the goal isn't to trade more, the goal is to trade better. The third part of the rule, the two, is about understanding the power of focus and respecting the limits of your own mind. Trading is mentally demanding. It requires constant observation, rapid decision making, and emotional control, all while managing risk in a constantly shifting environment. It's not something you can do effectively for 6, 8, or 10 hours straight. That's why the 2-hour trading window is non-negotiable. 2 hours is the optimal time frame where your mind is sharpest, your concentration is strongest, and your decision-making is clearest. Anything beyond that, and fatigue sets in. The longer you sit, the more likely you are to make mistakes. Think about it. Every minute you stay in front of the charts, your cognitive energy depletes. The more trades you watch, the more your emotions get stirred. You start seeing patterns that don't exist, setups that aren't valid, and opportunities that are just illusions. Eventually, your discipline collapses, and you start trading out of boredom or frustration. The two in this rule is your boundary. It tells you when enough is enough. It's a time limit that forces you to be efficient, to plan ahead, execute quickly, and walk away when your window closes. Those 2 hours are your battlefield, and when the time is up, you exit the arena, win or lose. Sometimes your trade might last only 10 minutes. Other times it might take the full 2 hours to develop. That's fine. What matters is that you're operating within a controlled, focused period. You're not chained to your screen all day, reacting to every tick. You're a sniper, not a machine gunner. When you learn to stop after your 2-hour window, you gain something even more valuable than profits, peace of mind. You start viewing trading as part of your life, not your entire life. You have time for rest, reflection, and personal growth. You no longer obsess over missed moves because you know your time will come tomorrow. In professional sports, no athlete performs at their peak for an entire day. They have defined periods of performance and recovery. Trading is no different. Your 2-hour window is your performance zone, and everything outside of it is recovery and reflection time. That rhythm is what keeps you consistent, calm, and focused for years to come. The two is about sustainability, because the key to long-term trading success isn't how much you trade in one day, but how many days you can trade with discipline, focus, and clarity. Discipline is the foundation of every successful trader, and the 912 rule is built entirely around cultivating it. It removes chaos from your day and replaces it with structure. It relies on systems and boundaries. When you follow this rule, you train yourself to wait before you act, to plan before you enter, and to stop before you spiral. You start understanding that discipline as it's about protection. Protection of your capital, your energy, and your peace. In real life, trading isn't a movie montage where you sip coffee and print money on your screen. It's an emotional grind, a test of your patience, and a constant battle between logic and impulse. The 912 rule forces you to confront the truth most people avoid. Trading is not about constant action, it's about controlled precision. In practice, this rule makes you sit on your hands while the market baits you with fake moves. It makes you accept that missing trades is better than forcing one, and it keeps you focused when everyone else is burning accounts trying to make it back. The real-life side of trading under this rule means you'll often feel like you're doing less than others, but your account will tell a different story. You'll notice your wins start to mean more, your losses shrink, and your stress fades. Over time, your daily life outside the charts improves too, because you're not glued to screens 24/7. You learn to trade and live, not trade and chase. That's the balance this rule brings to real trading life. Let's say it's the New York session and it's 9:30 a.m. The market's had its open volatility. The traps have already triggered early traders, and you're sitting back watching how price reacts to key levels. You're calm because you're not trading yet. You're waiting for your moment. By 9:45, you see the setup form. Liquidity swept, clean structure break, volume coming in. That's your cue. You take one trade, risk 1%, and you ride it for 40 minutes. Win or lose, you're done for the day. You followed the 9-1-2 rule. You close your charts, take notes, and move on. That's a professional trader's day, focused, short, and emotionally stable. Now compare that to a trader who breaks the rule. They start trading at 8 a.m. during the chaos, take 4 trades before 10 a.m., and end up emotionally exhausted. Even if they win 1 or 2, they give it all back by overtrading. Their emotions spiral, and they start chasing setups that don't exist. By noon, they've wasted half their day and lost more money than they planned to risk all week. The difference between the two traders isn't skill, it's discipline. The 9-1-2 rule keeps you on the side of composure, while most others drown in their own noise. When you break the 9-1-2 rule, you instantly step back into the chaos that ruins traders. You start trading too early, catching fake moves, overanalyzing every candle, and letting FOMO dictate your decisions. You take 2, 3, or even 5 trades trying to make back what you lost, and before you know it, you've broken your plan, your rhythm, and your confidence. You stop trading from strategy and start trading from emotion, and that's when accounts die. Breaking the rule also creates mental fatigue that spills into the next day, making you chase even harder. One bad day becomes 2, then a bad week, then you're resetting your account again. The 9-1-2 rule isn't just a guideline, it's a guardrail that keeps you from driving your trading career off a cliff. It protects your money, your mind, and your focus. The moment you break it, you go from being the calm, focused sniper to being just another statistic in the 90% who lose. The 9-1-2 rule is more than a trading strategy. It's a success system that has continuously rewired how I have been able to approach the markets and myself. It teaches patience when everyone else is rushing, control when everyone else is reacting, and discipline when emotions are screaming for action. Trading after 9 filters out chaos. Taking 1 trade filters out overtrading, and trading within 2 hours filters out burnout. Together, they form a system that keeps the mind sharp, emotions steady, and account intact. It's a rule built from my experience, from losing days, overtrading sessions, and the realization that success in trading doesn't come from doing more, but from doing less, better. The 9-1-2 rule simplifies the noise into structure, the randomness into rhythm, and the stress into strategy. Follow it long enough, and you won't just trade better, you'll live better. You'll finally understand that mastery in trading isn't trying to controlling the market, it's about controlling yourself. And that's the true power behind the 9-1-2 rule.